We have to start the show with that April jobs report out this morning, and the numbers in that report look very, very good indeed. The economy added 263,000 non-farm payrolls for the month of April. The expectation was for 190,000. Now, of course, it is worth keeping in mind that the March number was downwardly revised from 196,000 down to 189,000. But this time, the unemployment rate also fell to 3.6% for the month. That is the lowest level since December 1969. Here is what Kevin Hassett, chair of the White House Council of Economic Advisors, had to say today about the jobs report.
The president was really excited to hear about the numbers, as we all were. I would say that the way Larry and I put it in perspective was that the unemployment rate is so low that the last time that it was this low, we were about to land on the moon, and I still had my baby teeth. And the last time that the unemployment rate for women was this low, Larry Kudlow, who's an old guy, check it out, he had his baby teeth, right? And so this is about the strongest unemployment report or employment report that I've ever seen.
All right, and here with more on the jobs report, we have Markus Schomer, chief economist at PineBridge Investments. Hey, Markus.
Nice to be here.
All right. Well, any surprises you hear? Obviously, there's the big headline number of the beat on expectations for the jobs added, but anything else of interest that people might be missing?
Well, I think what I would probably say is don't get overly enthusiastic about the number. I saw your previous piece, and yes, the headline number, of course, looks nice if you look at just the payroll number itself. But there were lots of things in this report that essentially confirm our thesis at PineBridge that we are in a process of slowing. For example, just look at the first 4 months of this year. Payroll growth averaged just under 200,000 compared to about 225,000 last year. So already in the first 4 months, because you mentioned the previous month, but the month before that was a 33, right? And Kevin Hassett wasn't on for that one, I assume. So the trend is starting to slow. We also see a slowdown in average hourly earnings growth. So if the labor market really was that strong, if that 3.6% unemployment rate, lowest since the moon landing, really was a signal of a tight labor market, shouldn't wage growth go up? It isn't. It's actually slowed again over the last couple of months.
Why aren't we seeing that wage growth go up?
Well, because that 3.6% number is not necessarily the perfect reflection of where unemployment really is. Because look at this month, for example. The reason the unemployment rate went down is not because lots of people got hired, because, as you know, it's a different survey that's underlying the unemployment rate, and that actually showed that employment went down, labor force growth went down, and the labor force participation rate went down again as well. That's the reason the unemployment rate fell, and not because lots of people got jobs. So we should not lose sight of that. There's lots of statistical anomalies going through these reports that often, I think, obscure the actual message. That's why it's, I think, dangerous just to look at this one number and say, wow, super, excellent, let's go home.
Do you think investors will respond with the same kind of muted enthusiasm when it comes to this report?
Probably once they've listened to more people like me, right?
Right.
Because I would assume once you start reading the deeper analysis of this report, you will see that this is what I'm going to say, for example. On the face of it, it was a good report. 363,000 jobs is a good number, but the trend is slowing. Wage growth is slowing again. And there's a weird thing going on right now that we've seen 4 months now, 4 consecutive months of declining labor force growth. So people coming into the labor force, it's slowing. And at the same time, the number of people who come from outside the labor force and find jobs. So this is sort of the untapped secret potential of people that could still fuel job growth in the future, has been declining in 3 out of the last 4 months. So I actually do see a lot of signs in that report that we are slowly starting to see a deceleration.
Right.
No recession fear, anything like this, but a deceleration in almost all these numbers, despite the fact that the unemployment rate, yes, I grant that, did set a new record.
So does that suggest that we're going to continue in this Goldilocks scenario? I mean, we heard Jay Powell at the press conference essentially say that he's not worried about an overheating, but they're going to stay on the sidelines in the meantime. Is that Fed case still intact?
I think it's still intact. The Fed will also look through the headlines into the details of the report. One thing that would make me a little worried is that one argument I have made for a while now is the key trigger for the next Fed rate hike It's not growth or inflation. None of that matters. The trigger for the next Fed rate hike is the unemployment rate. If unemployment goes back down, in fact, I even said 3.6%. If it goes back down to 3.6 or 3.5, I'm hedging my bets a little bit now, then that's a sign that we're not at neutral in our interest rate setting, and the Fed wants to be at neutral. So if we get another number like this, maybe another inch down to, let's say, 3.5 next month, I think the Fed rate hike in the second half of the year comes back on the table. Yep. And the problem is then all the optimism from stronger job growth, from stronger GDP growth is going to be curtailed by concerns about the Fed. So I think everything that's happening right now brings us back into a fairly Goldilocks scenario that growth will not go out of hand. There's no overheating, but there's also no recession because the labor market wall is holding, right? The consumer will not crack until we see much weaker jobs numbers, and we don't see them. So.
Certainly no rate cut when you see a report like this. The cut that Trump and others wanted.
No, I don't think this is consistent with a rate cut at all, no.
All right, Markus Schomer, thanks so much. Sure. A little bit of cold water, good insights.